All right, everyone. Want to welcome everyone to today's Passive Investor Series webinar, the 5 red flags to avoid when passively investing. Really excited to share this webinar with everyone. We got a few people dripping in here, so we'll wait just a couple of seconds and we're going to go ahead and get started. All right, let's dive in. Looks like we got quite a few people in here. I don't want to keep up everybody's time. I know everybody's got lots of plans and everybody's super busy. So we're going to dive right in. I'm really excited to talk about this topic today. This is a question that we get often here at Headway. It's a question I get very often as well. I'm a passive investor, and obviously being on the other side too as a general partner, as a sponsor, some of my friends and family come to me sometimes and say, hey, I'm looking at this opportunity, whether it's in commercial real estate or it's in some other type of asset class. And they always ask, what are some of the things I should look out for? Now, I would argue that there's potentially a lot more than 5. There might be 8, there might be 10, there might be 20. There really are a lot of potential red flags when you're looking at an investment opportunity, especially depending on the asset class it's in. But for the sake of time, for the sake of conversation today, we're going to talk about the 5 that we believe and that I believe are the most important red flags to avoid when you're passively investing. So let's dive right in. Real quick, before we get started, and I'll put this number up again at the end of the call. If you want these slides, just shoot me a text, 281 559 7061. Just text me, hey, Brian, I'd like to get the slides for the 5 red flags to avoid when passively investing, and I'll make sure those get over to you. I will need your email address, so make sure you put that in a text, and we'll be happy to send those over to you. Just a quick disclaimer, this webinar is for educational purposes only and should not be considered legal or investment advice. We're just here to educate people. Of course, we're not CPAs or attorneys, and you should always contact your CPA or attorney before making any investment decisions. A little bit about us before we dive in over here at Headway Capital. Headway was designed to build and protect the wealth of busy professionals, and our goal is to provide alternative investment opportunities that give our investors the freedom to do what matters most. We have extensive experience sourcing, vetting, and investing in alternatives through multiple cycles. So we provide accredited investors the opportunity to partner with us on commercial real estate projects. We've done over 40 projects under our belt. Most of our assets are here in the Houston, Texas area. I'm not going to talk too much about us, but we have lots of experience managing particularly multifamily properties. Our CEO and founder is Sid Shamim. If you don't know Sid, he's been in the business for quite some time. Headway was started in late 2017, as well as Headway Properties, which is our management company. And Sid, before that, was managing a pretty sizable residential real estate portfolio and decided it was time to graduate and get into commercial real estate. So just like you, he started off as a passive investor first in several transactions before deciding that he wanted to leave his W-2, his corporate job in the oil and gas industry, and graduate and sort of take the next step into being a sponsor and a general partner. And that is how Headway Capital and Headway Properties got started. His lovely wife, Anam, is our director of business development. She's involved with talking to a lot of our investors, developing our business, particularly in the physician field. She is a GI doctor, so she helps us connect with lots of doctors that are interested in passively investing that may not have the time to do all these projects on their own. Umar is our CFO. He manages all of our numbers and our spreadsheets. He's the guy that makes sure that once we acquire a property, that all of our income and expenses are hitting our expectations. And if they're not, what do we need to do to fix them quickly? And then my name is Brian. I'm the Director of Investor Relations here at Headway Capital. I got started in real estate in 2017 on the residential side. I was just buying some single family rentals. I got a handful of houses that I was keeping as a rental before quickly realizing that I didn't love the residential asset class. I really wanted to transition and grow in the commercial real estate space. So in late 2019, I decided to transition into multifamily, got some coaching and some mentorship, worked with a boutique private equity firm here in Houston, Texas for a couple of years in the investor relations position before transitioning over to Headway a little over a year ago in the director of investor relations role. So my job is to talk to all of our awesome passive investors and our potential passive investors to see if we're a good fit for them, because not every firm is a good fit for every investor, and not every project is a good fit for every investor. But I have the wonderful opportunity of talking to people from all over the country and hearing about their walks of life and sharing the opportunities that we offer with them. Our track record, a little bit about us. As I mentioned, been in the game for some time. We have a little over $500 million of assets under management, a little over 3,000 units, and over 400 active investors. and our target buy box. We like to buy properties that are in that 25 to 30% average annualized return. We really want to produce assets that have strong returns and strong cash flow. And we do this by being focused, purposeful, disciplined, and consistent. So we're really focused on what we do. We don't get shiny object syndrome buying properties. We don't get shiny object syndrome when we acquire properties. We like to stay super focused. We're really purposeful and disciplined with our decision-making process. We make sure that every dollar that we spend in our properties to maximize value is going to produce some sort of ROI. Otherwise, we will not do it for our investors or for our residents. We're really disciplined in our decision making. Like I mentioned, we don't get shiny objects. We stay super focused. Those go hand in hand, and we are consistent as well. We communicate as often as we can, and we really like to make sure we're present and available for all of our investors and all of our residents at any time. So let's dive right in. Enough about us. Let's talk about the 5 red flags to avoid when passively investing. But you may be asking yourself, why is this important? Why are these red flags important? And the first thing I like to highlight anytime I talk to any investor, especially if they're a newer real estate investor, they've never invested in alternatives before, commercial real estate, passive investing in, say, multifamily, for example, is something that's very new to them. Is passive investing involves an element of risk, right? Anytime you're investing in anything, stocks, alternatives like gold, silver, commercial real estate, ATMs. I mean, the list of potential investments is long. There's an element of risk involved, right? So you need to understand that and understand the risks that are involved and the red flags that you should avoid when you're investing in this particular asset class, because understanding these red flags will help lower the chances of investing in the wrong deal with the wrong operator, right? So if you focus on these five red flags, now, like I said at the beginning, there's a lot more, but if you focus on these 5, it's going to help you. It's going to help you make better investing decisions. And now it doesn't guarantee anything, of course. These are investments. There's risks. They may perform, they may not perform, but it's going to help you avoid making bad decisions with bad operators and bad deals, right? So these are red flags. And remember, if you see these when you're analyzing any properties, whether they're multifamily or different asset classes, you should be concerned. You should be asking lots of questions. And personally, if I see any of these 5 red flags, I very quickly say no. I know when I was a much more novice investor, I would often get very fixated, and we'll talk more about this. It's one of the red flags in the returns, right? I'll look at the returns and be like, oh my God, this thing's got a 8 or 9% cash on cash. It's got a 17% IRR. It's got a 25% average annualized return. I'm gonna 2.5x my money in 5 years. Like, this is amazing. I'm going to invest, right? But if you're not watching these red flags that are not just wrapped around the numbers, you could get caught in a bad deal, right? So really, really, really important that you pay attention. Really important. Let's dive into number 1. The first red flag that I like to talk about is the operator's resume. Why is this important? Why is it important that you understand who you're partnering with? So I'll use, just to define that term, the operator is often called the general partner or the GP, often also called the sponsor. It's essentially the person that you are partnering with who is going to find the deal, manage the deal, operate the deal, and eventually sell the deal. So you are a passive partner, you are an LP or a limited partner, and the other side of the coin is the operator or the general partner. So we're talking today about the operator's resume. So not your resume, but the person like us over here at Headway, we are considered operators. So here are some traits that I personally like to look for in an operator that I invested with. 1, I like to see, is there a college degree and education, right? Somebody who graduated college, somebody that has some sort of education. That's really important to me. Not that there aren't people out there that potentially are successful without a college degree, but it's just one of those things that gives me a lot of comfort knowing that somebody graduated college and has some sort of degree, especially if there's advanced degrees like masters and things of that as well. But again, not a requirement, just something I like to see. 2, and I think this is arguably one of the most important ones, is having a successful background in business. What a lot of people fail to realize when they're investing in multifamily real estate is you're actually not just investing in real estate, you're investing in a business, right? You're investing in a business that so happens to be on the top of a piece of land that provides housing, right? This is really a multi-million-dollar business, right? You're talking about a $10 to $30 million property, and there is cash coming in, there's cash going out, there's income, there's expenses, there's employees. That's a business. If you've never ran a business before successfully, then there's a high likelihood, obviously no guarantees, there's a high likelihood that you might struggle to run one of these assets because you've never been in business before. You've never been successful in business before. So I want to see, what did this person do before they were in a multifamily sponsor? And then if they're currently a sponsor and they've been around for some time, have they been successful in what they do? The third thing I like to see is, have they seen different market cycles, right? Right now, we're going through a very challenging time in the market cycle. The Fed started raising interest rates in March of 2022. Good news is they announced the other day, a couple days ago, that or yesterday, I believe, that they are keeping rates the same. They're not raising rates, which is great. But we're going through a market cycle right now. So the question is have they seen different market cycles, or have they only been in when things were good, right? So that's a good question you want to ask. And I want to see sponsors typically that have seen some different market cycles. It doesn't mean that they will have had to been around for 30 years, but I want to make sure they understand that the market changes, and they should be mitigating risk by making smart decisions to make sure that if the market turns while we are in this investment, they have the savviness and the experience and the knowledge to be able to ride the wave, so to speak. The next thing on here is I really want to see multiple partners and team members. And part of the reason that gives me assurance or comfort is I don't want all of the work of managing the asset to fall on one person, right? Now, a lot of people will say, well, they're going to hire a third-party property manager anyway. Why does it matter? Well, the reality is, if you don't have multiple partners and team members involved in the project, the chances of success drop drastically. One operator or one sponsor or one general partner cannot be looking for new deals after they close one, managing the current portfolio, making sure things are going really well, talking to investors, reviewing financials. This is really a team effort. It takes an army, so to speak, to really make sure these deals are successful. So I want to partner with operators and firms that have multiple partners to help mitigate risk, and I want to make sure they have a team in place that can take care of all the little tasks on a daily, weekly, monthly basis that need to be done to successfully manage these properties. And then the last thing that I am looking for here on the operator's resume is transparency and communication on past deals. So I want to make sure that if they've been in other projects, if it's ideally it's not their first deal, what's their transparency like? Did that deal go well? Did it not go well? If it didn't go well, are they able to speak to why it didn't go well? If they've done things like capital calls, being transparent about that. Why do they have to do capital calls? How did that go? What did they learn from that experience? I want to make sure that they're really good at being transparent and really good at communicating, because the reality is not everything's always going to go well. Sometimes these investments might go through a rocky road because of the market, right? And if things aren't going well, I want to know about it. And if things are going well, I also want to know about it. I have heard lots of stories, not necessarily, bad deals, where people invest in a project, they wire their money, and they don't hear from the sponsor for 6 months, 3 months. They only hear from them every so often. The deal ends up selling, everybody makes a bunch of money, and everybody's happy because the deal was great, but they still won't go back and invest with that person again because of the lack of communication, right? So that communication to me is really, really, really important. Traits I believe you should be cautious of. One is kind of opposite of the traits to look for. No experience as an entrepreneur. Being a real estate professional and a operator is an entrepreneurial venture. And if you've never been an entrepreneur and you've only been a W-2 employee, it doesn't mean it's a bad thing. Everybody has to start from somewhere. But I personally like to work with people that have entrepreneurial experience. Have never ran a multi-million-dollar business, which I've talked about already, and have never owned any kind of real estate before. So if you're going from being a W-2 employee and you've never owned any type of real estate before, and you don't understand how the real estate game works, so to speak, or the business works, I should say, that's a red flag for me personally. I like to work with people that have done deals before, that have a track record, that maybe started in one asset class and grew to another, or just have a successful track record in a particular asset class. One operating partner and no team staff. I talked about that, right? There needs to be a team to really make sure the deal is successful. And then the last thing is the opposite of the last bullet point up top, is not being transparent about past performance and lesson learns, right? So if they make it sound like everything's great and amazing all the time, no matter what, doesn't matter what's going on in the market, doesn't matter what interest rates, doesn't matter about residents, doesn't matter about COVID, they act like everything's great all the time. That's usually a red flag for me, because there are lessons to be learned along the way in any type of business. And if these entrepreneurs have been around for some time, they've likely seen some market cycle. They've likely had some challenges. They've likely learned some things from these challenges. And if they're not capable and of communicating that to me as a passive investor, that's something to me that's a red flag. I want to make sure if somebody made a mistake or if they went through some sort of market cycle, I want to make sure they learned from it and they're applying what they learned to their next investment. So that's number one, the operator's resume. Number two, really important to me as well, is partnering with full-time versus a part-time operator, right? So personally, for me, I like to invest with people that are full-time. I'm wiring or giving somebody $50,000, $100,000. A lot of our investors put more in. I personally want to make sure that I'm investing with somebody who is all in, right? Somebody who's focused on my protecting my capital first, and of course, growing it. So investing with part-time sponsors can be risky, but it's not always a deal breaker, but it's an important thing to consider. So there are people, of course, we all start from somewhere, that are W-2 employees, 9 to 5, Monday through Friday, or 8 to 5. And then after 5 o'clock, they go home, they eat dinner with their family, and they're hustling in the evening. We all start from somewhere, right? And they get their first deal, their second deal, their third deal, and then they finally are able to leave their W-2 job and go full time. So that's very common in our industry, and it's not necessarily a deal breaker, but it adds an element of risk knowing that that person is not all in. So for me, if somebody on the entire sponsorship team is not full time dedicated, it doesn't have to be everybody. That's usually a red flag for me personally. Remember that you're investing in a multi-million-dollar business, and to me, that requires full-time attention. And even though you might say, well, the person is just hiring a property manager, they can go back to their job, what's the big deal? Well, property managers still require daily management. Ask us how we know, right? So we have our own property management company here at Headway, and we have assets that in the past we've used third-party managers for in markets outside of our primary market, Houston, and they still require attention. You know, they're going to be sending emails, they're going to be sending texts, they're going to be giving phone calls. And if you can't pick up your phone during the work day or stop and help them when they need something, if there's a sort of soft emergency, that could be a problem, and it could damage the property's performance and the reputation of your property as well with your residents. So you got to be active and you got to be full time. Now, managing a portfolio part-time is almost impossible. And what I mean by portfolio is if you've got a handful of deals or more as a part-time operator, that's really challenging to manage when you're part-time. It really takes full-time attention. This is not a 40-hour per week type of career, being in the commercial real estate operator space. Me personally, I'm working, 50, 60 hours plus a week, depending on what's going on. And I'm not even on the operations side. We have a team that does that. So it's definitely not something that I would recommend anybody to invest with somebody who's 100% part-time, especially if the entire team's part-time. And the last thing is it really impacts your ability to communicate, right? Part-time operators are going to have less time to communicate with their investors. They're going to have less time to communicate with their lenders, their vendors, and their property managers. So again, just for me personally, number two, red flag, I like to partner with full-time operators. I try not to partner with part-time operators unless there's a compelling story and somebody on the team that's going to be focused on the asset management full-time. They don't work a W-2. Number three, financial modeling red flags. So this is one I really like to talk about. And I was kind of alluding to this when I started the webinar, that I think it's really important that you don't just look at the returns to determine if a deal is good. This is something that I used to do. This is something that I've had, offering memorandums, decks sent to me, and people get really excited because they're looking at the returns that look amazing in the marketing material or on paper or on an Excel spreadsheet. But there's certain items that you really need to look out for on the financial side that could be red flags. So one, the first thing on here is modeling a refinance into the projections, right? To me, that's a big red flag. Now, do we love refinances? Yes. Do we want to do refinances and return back some of our investors' capital while also keeping the property and continue to cash flow? Yes, but you cannot put that in your financial model. If your performance expectations are 100% based on a refinance, that is a very, very, very aggressive and a very, very risky assumption, because there are no guarantees that you can refinance, right? What if the market turns? What if interest rates go up? What if there's a fire on the property, one of the buildings go down, and now you're not hitting your occupancy, so the lender won't let you refinance? There's so many variables that could go on that prevent you from refinancing, that if your return expectations are 100% defined or dependent, I should say, on a refinance, that is a very risky strategy. The next thing you'll see on here is the exit or sale cap rate the same or lower than the entry cap rate. So when we buy a property, when we acquire a property with our investing partners, there's a certain what we call a going in or entry cap rate that we are buying the property at. Then when we sell the property on the financial model, we have what's called a exit or reversion or sell cap rate, which is the cap rate that we intend to sell the property at. What you don't want to see is the cap rate be the same or the cap rate be lower. That is very, very, very aggressive, right? So if you're buying it, say a C-class property at a 6.5 cap here in Houston right now, and then in 5 years, you plan on selling that same property at a 6.5 cap, or you plan on selling it at a 6 cap or a 5 cap. That's a very aggressive assumption, assuming that cap rates will actually stay the same or compress. So for me personally, I like to see the reversion or exit cap rate actually be a little higher. So if I'm buying at a 6.5 cap, I want to see it at 6.75, or I want to see it at 7. I usually 0.05 or 10 basis points per year is sort of my personal preference. A lot of people like to use 10 to be conservative. So if you buy it at 6.5, you hold it for 5 years. 10 times 5 is 50. So I want to see a 50 basis points spread. So I want to see a 7 cap on the exit, right? That's kind of common in the industry practice. But to me, if you're modeling it the same or lower, that is extremely aggressive and extremely risky. The third thing on here is rent growth assumptions aggressive, right? If you see aggressive rent growth, knowing right now that there's a lot of challenges in the economy, that again could be a red flag. Now, the definition of aggressive is subjective, and there should be some rent growth if there is a value add, plan in place for this particular asset. Meaning, for example, let's say we're buying a C-class property or a B-class property that needs granite countertops, it needs new appliances, it needs new paint, it needs new flooring, it needs updates on the amenities. Well, that's a value add strategy where you can spend some money and clearly get an ROI that will allow you to increase rents. That's what's called forced appreciation or forced rent growth, right? We're doing it by renovating and improving the property and improving the customer service and the tenant experience. There's another element of rent growth that's not fourth, that's called more organic rent growth. And organic rent growth is just the rising tide lifting all the ships. That is when the market is growing very fast or just growing in general, and it's picking all the rents up with it. So I'll give you an example. In 2021, here in Houston, rent growth, and actually all across the US, rent growth was record breaking, I should say, across the US, particularly in Houston as well. We had double-digit rent growth just in 2021 alone. I don't recall the exact number. I think it's somewhere between 14 to 16%, right? So if you bought a property in 2020 and you still owned it 1 year later in 2021, by the end of the year, you saw 14 to 16% rent growth by doing absolutely nothing. You could have never renovated the property and it just would have picked itself up. That's organic rent growth. I like to call that getting lucky, right? Natural organic rent growth without crazy market dynamics is typically 1 to 3% a year, depending on the market. Every market's different across the country. So you don't want to see aggressive rent growth assumptions. What I like to tell passive investors is if you see rent growth in the financial model, let's say, for example, you're looking at a deal, it's 150 units, and you see 3% rent growth year one. Okay, that's a fairly conservative number. What I like to ask the sponsor or the operator is how much of that was forced, how much of that is organic, right? If you ask that question and they can't clearly answer it, that's a red flag to me as well. But it'll tell you where their mindset is. What are they thinking about? How much of it is the market and how much of it is actually the operator improving the value and the experience at the property in order to be able to justify charging higher rents. The next thing is renovation assumptions aggressive. This is another one where if you are inexperienced, this could be something you do unintentionally or accidentally, I should say, where you assume that you can renovate units faster than you actually can. If you are buying a value add property and you've never renovated units before and you've never been the lead sponsor sort of controlling the business plan, there's a chance that you might assume you can renovate more units faster than you actually can, right? So you don't want to have renovation assumptions be too aggressive, because if you assume you're going to renovate all your units, say in 12 months or 18 months, but it actually ends up taking 24 months or 36 months, that could be another red flag, because if the returns or the cash flow that investors were anticipating getting, say year 2, 18 months in, is not actually hit because the renovations take 24 or 36 months, that's going to be very disappointing as an investor. I wouldn't say necessarily, it's not the end of the world, especially if the business plan still goes well and you end up selling the property for a profit. But if I thought I was going to start getting a 6 or 7% cash on cash return year 2, and I end up getting a 2% or a 1% or 3%, I just basically missed the mark. I'm very disappointed by that. And that could be because they assumed they would renovate the units faster than they can. So you want to make sure you're partnering with an operator who's experienced, who's renovated units before and knows exactly what their team can handle. The last thing on here, and there's plenty of more financial red flags I could go through, but the last one I'll talk about for today, this evening, is not enough operating reserve. So what does that mean? So as the operator, as a sponsor, we have an account for each property. It's not an umbrella account that manages a bunch of properties. It's an account for one property that is for operating reserves, cash in a bank account, ready to go at any time in case something goes wrong. That something could be anything. It could be COVID. That's probably the best example I could give that everyone is aware of. It could be a fire on the property that knocks down a lot of the properties that impacts your ability to collect rent. It could be a natural disaster that comes in and affects your residents' ability to pay rent. There's so many things that could happen where you might need, as the operator, to tap into that operating reserve account and spend that money in order to keep the property afloat so that you're not going into default with the lender, so that you're not getting liens put on your property from contractors or vendors that service your property that need to get paid. You're paying your invoices and your bills on time. If you don't have 3 to 6 months, 3 being the minimum, 6 being the maximum typically of operating expenses, in general, set aside in a cash bank account the day that you close the property, to me, that's a red flag. So typically, it's a really easy formula. If you're looking at somebody's underwriting, or you're looking at financial model, and you see, for example, that there are on a monthly basis, there's, let's just say, $50,000 in expenses. I want to see $150,000 to $300,000 of cash sitting in the operating reserve account when the property closes. I want to make sure that that's there as a passive investor. That gives me confidence that there's cash in the bank. And what happens? Let's talk about what happens if there aren't any operating reserves. Well, if there aren't any operating reserves, or if the operating reserves are soft, let's say they only have 1 month of operating reserves instead of 3 to 6. Well, if something really bad happens, like COVID, for example, and it impacts you long term, what happens at that point? Well, one of 2 things can happen. One, you run out of cash, you lose the property, the bank takes it back, right? It's probably not the first thing that happens. Typically, the most common thing you're going to see is the operator or the partner or the sponsor, the general partner, will come to the investors, the passive investors, their partners in the deal, and say, hey, we're out of cash. I need you to put some more money in, right? That's called a capital call in our business. They go to you as a passive investor, or me if I'm the passive investor, and they say, hey, Brian, we ran out of money. It's kind of the easy way to describe it. We got ourselves in a pickle here, and I need you to invest into this capital call we're doing to fund our operating reserve so we can sort of ride this wave out. That is happening in some markets and some properties today with the interest rate environment we're dealing with. And even some operators that had 3 to 6 months of reserve have still been hit pretty hard because of the interest rates, taxes, and insurance and different market variables. But having enough operating reserves, at least 3 to 6 months, will help you weather the storm if these things happen. So just something to keep in mind. Again, a big red flag that I see if I don't see enough operating reserves. Number 4, talking about distributions and returns. This is something that I think a lot of people don't necessarily ask or think about. And I think it's really important. So one, you want to make sure, and you can find this out. One, you're going to want to ask the sponsor. 2, you should look for the answer for this inside of the PPM. Now, a lot of people don't read the PPM because it's a very long document prepared by an attorney, often 100 pages or close to it or over, right? It's a very, very long document. And people are like, oh, I'm not going to read all that. I'm just going to sign, wire my money, good to go. Well, you need to find out before you invest, is the money, the returns that you're going to be getting while you're in the partnership, whether they're monthly dividends, or quarterly dividends, biannual, annual, however the sponsor pays their dividends to their investors, are they a return on capital or are they a return of capital, right? That's really, really important. You want to make sure your returns are a return on capital and not a return of capital, right? the sponsor should not be giving you back the money you invested. That doesn't make a lot of sense, right? You invest $50,000 and you start getting quarterly returns 3 months later, 60 days later, and the money they're giving you feels like a return, but they're actually just giving you your money back. That's a return of capital, not a return on capital, right? Or if there's cash flow from the property and they are generating cash flow and they pay you a dividend from that cash flow, and they're saying, hey, we're actually paying you down, we're returning the capital that you gave us to borrow this property, right? To buy this property. So you invested $50,000 and I'm going to give you $5,000 the first year. So a 10% return. And that money is buying you down. So at the beginning of year 2, now you only have $45,000 of principal. Then at the end of year 3, you have $40,000, right? So they're buying you down. Why is that important? Because if the deal has a preferred return, or often referred to as a pref, it's crucial in our opinion for investor alignment that you make sure that your principal stays the same, because that preferred return is determined by how much cash the sponsor owes you. So if they're paying you down, the preferred return, your payments, your dividends you can get will actually drop on an annual basis. So you don't want to be getting less cash as you're invested in a deal. You want to be getting the same amount, if not more, right? So you want to make sure you're in the returns that the sponsor is providing is a return on capital and not a return of capital. Again, that can be found in the PPM, and you should always ask the sponsor to make sure that the PPM and what the sponsor says line up. The second thing I just kind of mentioned is you want to make sure there's a preferred return. This ensures that the passive partners are paid minimum first. So the preferred return ensures that you, as a passive investor, as a passive partner, as a limited partner, get paid at least the minimum percentage that's promised in the preferred return before the operator or the sponsor or the general partner takes a penny, right? So if you invest in a project in the PPM and in the documents, it shows that you're going to get, say, a 6% preferred return. The sponsor or the operator, if it was Headway in this example, we wouldn't get a penny of that until you get your minimum 6% preferred return, right? So that's really important. And to us, that incentive, that aligns incentives, ensures that the partners are paid first. Our passive partners are the ones who helped us acquire the deal, and we want to make sure they get paid first, right? We usually get paid last. So that's really important to make sure that your preferred return is a true preferred return, and that there's not any types of catch-ups or anything like that for the general partner. It should all go to the passive investors, right? And the last thing I'll put on here as far as distributions and return is avoid crazy preferred returns to lure you into bad deals or funds. I have personally seen some really crazy or interesting preferred return models. I've seen some that are really, really high in certain asset classes. Maybe it's not as abnormal, but talking particularly about multifamily apartment complexes, it's very uncommon that you're going to see a 12, 14 plus % preferred return, right? So for me, if I see a really high preferred return, I am asking a lot of questions, right? Because what a lot of people do from a marketing standpoint is they'll promise a really high preferred return to get you really excited as a partner, but they won't actually ever hit that preferred return throughout the life cycle of the deal until the deal actually sells. So you don't want to make the assumption that, like, for example, let's say it has a 14% preferred return or 12% preferred return. Just because it's 12% preferred return doesn't mean you're getting 12% every year that you own the deal. Maybe there's only 4 or 5% of cash flow. So they're actually going to be constantly playing catch up with you, and you actually won't touch that 12% till the deal sells, right? So to me, I'd rather see a more realistic or conservative, I should say, preferred return. Typically in our industry, you're seeing 6 to 8%. I don't need to see some sort of crazy preferred return, because to me, when I see a really high preferred return, that is screaming that this deal is really risky, usually. Again, not all deals are the same, but usually if you see a really high preferred return, it often means a deal has a lot of risk involved, and they're trying to incentivize you to invest by raising the preferred return, knowing that that's going to help ease you a little bit mentally, because it's a more risky deal, right? So be very careful of seeing really high preferred returns. Last but not least is I will talk about the sort of elephant in the room when it comes to red flags, at least today, as of this recording, is using the wrong debt instrument, using the wrong leverage, using the wrong debt tool, so to speak. There's 2 types of debt that you typically see most commonly in the multifamily apartment space. One is agency fixed rate debt, meaning the interest rate does not change. It stays the same throughout the hold of the term of the note. And then there's what's called bridge debt or floating rate debt. That essentially means exactly what it sounds. It's usually a 3-1-1, so a 5-year term, 3-year term with 2 1-year options to renew. And the interest rate has the ability to change on a month-to-month basis unless you have an interest rate cap, right? So fixed debt brings lower leverage but security. So typically you're not going to get as much leverage in the fixed rate market, but it does bring an element of security because the rate's not changing. It's also agency or government backed. Floating debt can bring slightly higher leverage, so you can actually get more money from the lender for things like renovation, right? But it comes with an element of risk because of that interest rate and because of the short-term nature of floating rate or bridge debt. 3 years sounds like a long time, but it's not, right? Deals move very quickly, and you could really quickly run out of time and start getting close to that 3-year mark. And at that point, you would need to either refinance or sell the property. Well, if you're not meeting your business plan, that could get really challenging, right? So floating rate debt is riskier in today's market for sure. But if you choose floating rate debt, it must have a tight interest rate cap to avoid volatility, right? So what that means is sometimes I wouldn't say floating rate debt is always bad. I'm not going to say never invest in a deal that has floating rate debt, but what I will say is you should be very cautious because it's more risky in today's market. And if the business plan is to get in and out of the deal as fast as possible, say 3 years or less, floating rate debt could be argued by some that it's a good tool to use because it doesn't have a prepayment penalty like fixed rate debt will. But you got to really make sure that you have a tight interest rate cap, meaning you want to make sure that the sponsor or the operator is buying an interest rate cap. And an interest rate cap is essentially something you buy at closing that will help put a ceiling on how high your interest rate can go. So, for example, let's say, just make up numbers. Let's say interest rates today are 5.25, right? You buy a 1% strike cap. So your interest rate won't go more than 1% above whatever your spread is. Usually it's, SOFR plus a certain number, right? So that protects you that as long as your deal can financially withstand that extra 1% of interest rate raising, so to speak, or rising throughout the life cycle of the deal, you're okay. Now the interest rate caps typically expire. So if you're buying a 3-year, if you're on a 3-1-1, you could buy a 3-year interest rate cap, and it's going to expire at the end of the 3 years, which means you will have to buy another one, right? So if it's at the end of year 3, if you still need to sell hold the property, market's not good, you will have to buy that interest rate cap again. So there could be a need for more cash, which is just another thing to consider because that cash has to come from somewhere, right? So it could come from 3 spots. It could come from cash flow from the property. The lender may start making you escrow and set money aside for the interest rate cap extension. It could come in the form of a capital call, meaning the sponsor or the operator comes to you and says, hey, Brian, we need to buy another interest rate cap. And unfortunately, the business plan hasn't gone well, and we don't have enough cash to do that. So we need to, we need another $1 million. So we're going to go to all of our investors and ask them for an additional contribution, right? Or it could come from the sponsor's pocket, meaning if the sponsor or the operator, the general partner, has the ability to buy that interest rate cap on their own, they of course could go out there and do that, and make sure the rate cap gets bought. So just something to consider when you're investing in floating rate debt or bridge debt. Again, I'm not going to say it's a tool that you should never use, but it does add an element of risk. And right now in today's market, I would call it the unpreferred form of leverage. Most people are leaning very heavily on getting agency fixed rate debt. How do we stack up with this, right? Let's transition a little bit. We're getting here, wrapping up towards the end. So if you have any questions, please put them in the Q&A box. But how does Headway stack up according to these 5 things? So the first thing we talked about was the operator's resume, right? We have extensive background of successfully managing multiple 7-figure businesses, right? So we have a lot of properties in our portfolio, and they're all anywhere from $10 to $25 million properties. So we have a lot of experience managing these 7-figure businesses. We are full-time operators, right? We are all in. We're not part-time. Anybody here at Headway is part-time. Financial modeling, we never model a refinance, and we leverage outside market experts to confirm our assumptions. So that's something that's really important to us. We always talk to third-party vendors, whether they're property managers, tax advisors, insurance advisors, to make sure that our assumptions in our modeling are accurate. Distributions and returns, we always distribute cash flow as a return on capital, not a return of capital, and we always offer a preferred return. And last but not least, from a debt standpoint, we leverage our experience and our advisory team to choose the right debt for the business, right? So most of the time right now, I will tell you, we are looking at fixed rate debt only. There is a time and a place for bridge or floating rate debt, but we are really leaning heavily and trying to model all of our deals on fixed rate debt just because of the state of the market. So just something to be considered, and why I believe we are positioning ourselves to take advantage of some good deals. We stack up against all other operators and all these 5 items we mentioned. So just real quick, final statement before we wrap up and answer any questions we have coming in. It's really important that you go back and review these 5 red flags to avoid when passively investing. Again, text us if you want the deck, or shoot me an email. These are 5 things that can really help you succeed when it comes to being a investor in alternative investments like commercial real estate. There's a lot more potential red flags to look for. And if you want to discuss any of those red flags on a phone call, or any of these red flags themselves, the 5 that we talked about today, I am always willing and happy to hop on a phone call and talk to anyone who wants to discuss what you should or should not be looking for when it comes to a passive real estate investing, especially in multifamily in today's market. But please go back, write these things down, take some notes, and make sure that the next time you're reviewing a deal, whether it's from us here at Headway or from another sponsor or operator that you may be connected with, these are things that you should always have a checklist for, and make sure that you don't catch any of these red flags before you invest. Just real quick to cover before we jump into Q&A, a little bit about us and what we do here at Headway. We focus on apartments. We do have a real estate income fund as well, and we do occasionally offer car wash investments. If you want to get access to these investments, you do need to be a part of our private investor club. I see several private investor club members on this call today, so excited you guys are here. But in order to join the club, you do have to be an accredited investor. And what do you get by joining the club? You'll gain access to member-only in-person events. So we do property tours and investor dinners. We also do educational webinars just for our investors outside of this one. We also provide exclusive passive investment opportunities for these investors. They get first dibs at these deals before we release them to the public. You do have to submit an application that's on our website to be a part of the club. And you do have to have a qualification call or meet me in person to discuss. Most people just have a quick call with me. It doesn't take very long. And you must be an accredited investor. That just means you have to have a $1 million net worth, not including your primary residence, or you have to make $200,000 a year. If single, $300,000 a year. If married, 2 out of the last 3 years, with the plan of making that in the foreseeable future. So scan this QR code if you want to join our private investor club, or if you request this deck, this link right here will take you right there. You can also visit our website and find the link there as well. And last but not least, we are excited to continue to present this offering for you for our Headway Capital Income Fund. If you've not heard of this before, this is our open evergreen fund that invests into a hard money lending opportunity that provides an 8% return to our investors for a $100,000 investment. It is a liquid offering in the sense that you can get your money back within 90 days or less once you invest. So that is nice about it. It also provides either monthly distributions or dividends if you prefer, or you can leave your money in and actually let it compound. It is backed by real estate. So that is something, if you're looking to invest in the real estate, but you want some form of liquidity, this is a great option. It doesn't provide any upside, but if you want to learn more, scan this QR code, or when you get this deck, click on this link here. We do have a investor webinar presenting this opportunity to our investors coming up soon. So either sign up for that or check out the recording, and you'll learn more info about this offering. Questions and answers, again, you want text me if you want these slides, 281-559-7061. And I just want to say thank you to everyone for attending. Let's see if there's any questions in the Q&A box. Please drop them in if you have any questions. Quite a number of people here. Sometimes it's super quiet, even though there's a lot of people watching. So let's see what we got here. Let me pull up the Q&A box. What is another red flag that you did not talk about today? That is a good one. Another red flag that I did not talk about today. I think personally, another red flag is if I see an operator or sponsor that is divided in too many different asset classes. So now bigger firms can do this. Let me start by prefacing that. If you are a big firm and you have probably $1 billion or more in commercial real estate, I don't necessarily consider it a red flag that they have different asset classes because they have the team to do it. Most of these $1 billion plus firms, they probably have 100 employees, if not more. They're very sophisticated. They've got people in all kinds of departments. That gives me confidence. But if you see a small firm, and I don't exactly have a number, but let's just say they've, got under $250 million in assets, and they've got all these different options of offerings, and they are operators. I think that's a really challenging place to be. And I personally think it's a red flag. So, for example, somebody sends me something and I notice that the operator, the sponsor, does apartments and they do retail and they do strip malls and they do, or I guess it's the same thing. And then they do self storage, they do mobile home parks, they do land, they do car washes. So they've got all these different offerings. That may sound attractive on first glance, like, oh, these guys are great. They have all these different offerings. I would argue, how can you be a master at anything? If you're a master of everything, you're a master of nothing. There's some sort of saying like that. You don't want to have shiny object syndrome if you are in our line of work. You really want to stay laser focused, which is why we spend 90% of our time in multifamily. We do have our income fund, which provides a nice cash place to park cash for our passive investors. And we have some operating partners that we occasionally partner with on car washes. But besides that, we stay really focused on what our offerings are. And if we get into something new, we do it with extreme due diligence, right? So it's really important to try to not focus on too many things at the same time, in my opinion. So 3 or 4 things is starts to get a little stretchy, and if they're not big enough and they don't have anywhere from 500 to $1 billion of assets under management, I think it can be really tricky to have too many asset classes to offer your investors. So that's a red flag for me personally. Let's see what else. Are there any red flags when it comes to a market? Oh, that's a good question. We didn't talk today about markets. And by markets, I guess we're talking a little bit about location. Where is the asset itself? There definitely are some red flags when it comes to market. And I would encourage all passive investors, all passive partners, limited partners, to always do due diligence on the market they're investing in, right? So ideally, the sponsor provides or the operator provides some sort of documents or data or information, I should say, on the market that you're investing in. They should have information on the crime, population growth, job growth, average household income, things of that nature. But it's still important, in my opinion, that you go and do research yourself. So there are some red flags, in my opinion, on a location or a market. If I see declining population, to me, that's a red flag. I don't want to invest in somewhere where people are leaving. There's probably a reason people are leaving. Also, a red flag to me is if I see an average household income that is below the median income of that market. So, say, for example, you're investing in a market that has a $50,000 average household income or $50,000 median income. What you don't want to see is the property and surrounding area around the property has a $35,000 average household income within 3 miles. That just means that you're investing in an area that is below average, right? The people there or make way less money than the average surrounding community. That means you're probably investing in a C class asset for sure, potentially even worse. And to me, that's very risky. You're going to probably have issues with collections, right? You're not going to be able to collect rent because people are going to have a hard time paying. So to me, that is a location red flag. Again, population declining, average household income below what the market's household income is. And there's definitely a few other ones you can look for as well, as far as the community and what types of jobs are there. Is there job growth or is there job declining? Are there people building and moving in there? Those are all important things. And the last thing I'll mention when it comes to location is what's called in our market when it comes to apartments, absorption. So absorption is how many new apartments or deliveries, or what it's called, how many new deliveries are coming online, and then what is the expected absorption rate, right? So This is an important number when it comes to location, because if you're investing in, say, an A-class property, something a little bit newer, and there's a ton of deliveries coming online in the next 2 to 3 years, that's going to impact your ability to push rents, and it's going to impact your occupancy potentially, right? Maybe you're still really good at occupying and your occupancy stays okay, but it's going to be challenging to push rents if there's a brand new, shiny, beautiful property opening right across the street or right around the corner, right? Doesn't mean don't invest. It means that that needs to be a part of your business plan. And you should not see, back to one of my original points, you should not see aggressive rent growth when a new property is coming online, or as aggressive, I should say. Maybe the first 2 years it's aggressive because that new property is not there. And by year three, when that property is open, you're probably going to see a softening in the market because there's a new property right across the street, right? So again, not a red flag to stay away from, but you want to definitely keep an eye on absorption and how many deliveries and how many deals are coming online in that particular market. And this should be information that's all readily available from the operator, the sponsor, via what's called a CoStar report, CoStar. These reports typically have all the upcoming deliveries and the anticipated absorption rate as well. And the last thing, I keep saying the last thing, but one more just popped in my head that you're looking for when it comes to an area is crime. So you don't want to invest in an area that has a crime rate that's above the market average or above the national average, especially important. So again, just another thing you should be looking for when it comes to location. Those are all red flags, in my opinion, for location. All right. When is the webinar on the income fund? Oh, good question. So we are having another webinar for the Headway Income Fund actually next week. And then we'll have the recording available. So if you're watching this as a recording on our website, please check out our income fund offering on the top banner. Should be under the current offering section. But we are having, if you're watching this live, or you're here live, or you are watching this recording a day or two later, you should see some emails coming from us about the income fund. We are having a live webinar next week. So please keep an eye out for that. We'd love to have you there to learn more about the income fund and how you can diversify your portfolio. It's not correlated to the equities market, which is great. And you can also earn some cash flow, monthly dividends cash flow from the income fund. So we'll be having that next week. Great question. All right. It looks like that was it for tonight. So I want to thank everyone for attending. This was a really hot topic. Not surprised. It's definitely, and we're in a market right now where I think you really need to be cautious about these red flags, so to speak. So I want to thank everyone for attending today, and I look forward to seeing everyone next week. Have a good day.